Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. And today we're going to go into Twitter. We're going to look at some posts. I'll give you my financial opinions with it. We are going to talk a little bit about the housing market. I know a lot of people think that the housing market is just going to roll over and crash like no other. I am in the opposite camp. I don't think it's going to crash. I will give you my reasoning about that. And then we'll also go into some financial topics as well, investment stuff that's also related with what I'm sharing on Twitter. So if you want to follow me, you can follow me at finding_finance. That is how you add me on Twitter if you want to, and we'll get right into it. And I did post a platinum clip, a pretty cool clip on the platinum to gold ratio. If you want to check it out, definitely hit it. So this is what I wanted to talk about. It says, if you're waiting for the housing market to get vokered, I have bad news. It already has been. Affordability is likely to improve from here, largely due to lower rates and inflation, rather than large nominal price declines. So really what I think he is saying, and I believe in what he is saying, is that the mortgage rate is going to be the variable here. It's not going to be the home price as much. Now, home prices are going to move. They're going to be seasonal. Generally speaking, they're the most weak towards the end of the year, December, January timeframe in the winter, because people don't want to move in the winter. We've got the holidays, travel, et cetera, et cetera, et cetera. That's generally the worst time of year for home price appreciation. So it usually pulls back a little bit after August or so, or slightly before August, depending on where you look at it and what housing market. And then it kind of declines into January, and then you get that surge up in the new year as people start looking for homes, buying up homes. But what he's got here is he's got a mortgage payment index adjusted for inflation. We've got a very high unaffordable time going on right now. We also had that back in 1980. So when people say, the housing market's going to get vokered, it's going to have this big crash, well, it already has basically been vokered when you look at the affordability of housing right now. Now, I still think that the demographics out there, it's looking to buy. We've got checkable deposits that are through the roof. Perhaps those are being saved to buy a house. I don't know. But the affordability with this shock to the system, how fast it rose, it is a pretty big shock. I do think that this is going to roll over and come on back. We can look at the 30-year mortgage rate, and we'll do that together, and I'll show you what it looks like. But we've already been vokered, so to speak. And if you go into this, he's also got some other information here that I think is pretty cool. So it says, zooming in to see some key dates tagged, June 2020 was an incredible time to buy a home. And it remained that way through July of 2021. But it wasn't until maybe March 2022 that buying a home clearly became a bad value proposition. This has been shown in price stagnation decline. So it was really low back here, and we really shot higher with the interest rates and mortgage rates, I should say, with the mortgage rates. But I still think the demographics out there, I think we're in the middle of a construction cycle, and that will come back when interest rates go lower, which means that more people are going to be fighting for homes when these interest rates do come back down at whatever point it does. If you look kind of the long-term view on mortgage rates, this is the 30-year mortgage rate. You can kind of do your big long-term trend line here. And we've broken, obviously, to the upside. We usually get a return move, and then, unfortunately, it usually heads higher. So I would be looking for a return move here in interest rates, perhaps, to some level lower. And I don't know which level lower. It could be in any one of those three bubbles. But we've definitely broken out. We will get, I think, a return move to some point, and then we'll see where we go from there. And then coming back, it says, the other amazing time to buy a home was really any time between April 2010, May 2013, following the overvalued state of 2006 and 7, of course. In 06, 07, and then we had a really good spot down here in affordability And generally speaking, when you after the peak, you want to add 5 years. That's the rule of thumb. So if something peaks out, you add 5 years, and then you can get it back down here. But you got to keep in mind, home prices went down, and interest rates went down because the housing market crashed. I don't think the same dynamic is going on. I mean, I could be wrong, but and I don't think I am. But we're in the middle of a construction cycle, and I think affordability is what's really slowing this thing down. And I think he's nailed that. It says the most challenging time to buy a home was a very long drought, which lasted from September 1978 all the way to August 1991. 13 years with housing affordability as bad or worse than 2006 and 7, with only a brief reprieve in 1987. All-time worst affordability was in October 1981. Now, there is something I want to state here. A lot of the baby boomers bought homes in this time frame, back in this general vicinity back here. And it was at very high interest rates and very low affordability. Yes, they could have refinanced and got a little bit lower rate, but not really till past 1990, where rates came back down. So it would be in those types of situations, and the Dave Ramseys that basically said, how did you become a millionaire? How did you make all of your money? And they said, well, the first thing I did was pay off your mortgage as fast as possible because it has a high interest rate. And that's exactly what I would have done too. But the problem now is a lot of people are in the situation like myself, where you basically bought a home and you got to refinance at a very low rate, which is very much different than the all-time worst affordability of the 1981 or the 1970s or even the early 80s. That was all horrible affordability. So the first thing you'd want to do is pay that off as quickly as possible if you owned a home because of the high interest rate. So that's the situation there. Coming on down, this is platinum. It says, Renko, the noise remover has spoken. Major bull flag broken to the upside with a 100% measured move at $15, $18. This will result in a 20-year breakout of a massive formation for platinum. So this is a Renko chart. We got Uselink throwing down the charts here. And here's your massive bull flag, and then you've got another bull flag within the bull flag. We are breaking to the upside here. We're breaking out of the Renko chart, so it is looking fantastic for platinum. This doesn't mean that it will go straight higher every single day. It just means that we will be moving in the upward direction, grinding higher as the most likely case as we break out of these patterns. So that's kind of the path of least resistance, is higher, not lower. Looking at this, it says Goldman Sachs commodities have the best asset class outlook for 2023. And I think Jeff Curry also, he's the one that's really spouting that off. And check out, there's some shirts. Scott is making some shirts, and he's going to be selling some shirts. So definitely check it out. This is a silver keep stacking shirt. So check it out if you guys are interested. Here's Tavi. It says oil and gas exploration and production companies are by far paying their highest dividend yield in history of the data. Energy exploration and production stocks dividend yields, and you can see the dividend yields really kicking up here. So they are returning cash to shareholders, all of these energy companies. They are actually pretty cheap on a cash flow basis as well. I think there's a lot of opportunity in oil and gas, and especially energy service. I think I've showed this to you guys before, but let me go back to my energy service companies. Let me just type it in, OIH divided by XOP. And this, I'm getting, real into it, but this chart here is looking fantastic for OIH to XOP. And it doesn't mean that this will just go straight higher. We obviously could have a pullback, but overall, we've broken out of this wedge formation to the upside, and energy service companies could outperform for a good while, even over the exploration production companies. And XOP is undervalued in relationship to oil. It's very cheap for XOP, and the production companies are, they're only, PE ratios, their price to cash flow ratios, they're all super cheap. So OIH is ultra cheap, and they have existing infrastructure where they can generate massive amounts of cash flow given the right market conditions. That is where I look. That is where the opportunity is. You want to look at the opportunity in sectors where they have existing infrastructure. The cash flow infrastructure is in place to generate. You just need different market conditions. You need the commodity to come back. You need more pro drilling. I think that will come, especially if there's massive shortages in energy, which I do think is coming soon. So I think OIH is definitely a good spot to be looking in. At the membership, the finding-value.com, the platinum membership, discount for a coupon code, we are looking at energy service companies and potential opportunities there. And we did cover some this last platinum question and answer session. Looking at number of barrels bought back remains 0. Profit holding steady at 0. Oil plus 12% in 2023. So what he's talking about is how much oil the government has purchased back. They can't purchase it. They can't find suppliers to produce for them at the prices that they want. And I would hear this all the time. Oh, they're just going to go buy oil at $70 a barrel. Guys, they just dumped 218 or 213 million barrels on the market to get the price down here. They can't hold it down here. They're screwed. If they try buying it back, they're going to rocket launch this price higher. So you can't be a seller of 1 million, 1.5 million barrels per day worldwide, and then turn around and say, "Oh, we're going to buy it back at 1 million or 1.5 million barrels per day." They can't do that because you're going to send the price to the moon because the market's far too tight. And the market will eventually work its way higher. Now, what's happening is it's the physical market versus the paper market is what's going on now. It's going to be those two squaring off against each other. What does that mean? You've got the paper price, which people are trading, and they look at liquidity in the system. Historically speaking, more liquidity in the system is what's been driving the prices in oil. It's liquidity. It's the lack thereof or the excess in liquidity and the inflation. But as the physical barrels become real tight in the market, that's going to be another driver from a supply side. And I don't know. I mean, outside of 1970s, we really haven't had a huge supply-driven market in oil. It's always been liquidity-driven, like the early 2000s and mid-2000s. But we didn't really have a gigantic supply crisis during that time frame. It's going to get real interesting, and I'm very curious to see what prices do over this next year or two for oil, natural gas, and all these other ones. So I'm just curious. It's going to be a fun ride. And this is by selling oil from the SPR at 96 a barrel, we help reduce the price of gas when it was at its highest. Now, by refilling the SPR at today's much lower prices, we turn a profit for taxpayers. Problem is, they can't refill it. No barrels bought back because nobody wants to sell to them at these low prices. Are EVs effectively becoming another disposable item? How old will they be when they are effectively become zero valued because of the battery replacement factor? That's a great question. And I replace my battery in my car, I'd say every about 6, 7, 8, 9, 10 years, depending on the battery and the conditions that those batteries have seen. The ones that I run kind of lightly on my summer cars, they seem to last about 10 years. And my regular cars, they last about 6 or 7 at best. What do you do after those batteries go bad? You're just going to go buy a bunch more? You're going to dump the 10, 20, 30,000 to get them replaced? I don't know. I highly doubt it. So what are we going to do with all these cars that are going to basically be junk at a time which could be sooner than ICE vehicles? Now, I'm sure advances in battery technology will definitely help. It'll probably definitely prolong the life of the batteries. So that is something that we can look forward to with technology gains as well. It says, great visual on the elephant in the room in all policy discussions. We're going to be too broke at constant tax rates and entitlements, COLAs, to afford higher rates. This increase inflated all away probability over time, but Fed will try to hold on to 2% as long as they can. That's Jan 15. So this is close to 11 trillion in US Treasury bonds are maturing in the next 12 months, need to be refinanced. And that also could be motivation for we'll call it the Federal Reserve to push us into a recession and rates go down so they can actually refinance all this debt that's coming due in the next 24 months. That could be a strategy that they have that maybe perhaps people aren't thinking about, or maybe they are thinking about it. The current funding rate's 1.6 to 1.9%. The new one's 3.4 to 4.6. And you can see the interest as a percent of the budget explodes from 8 to 17%, and that's the green line here as we go forward. So we were very small back here, and it's starting to balloon up in terms of our interest payments if interest rates stay high for a long time. Here's bye-bye cheap goods from China. It says import prices just had the highest upward surprise in 22 years. This should be on the Fed's radar. So this is U.S. import prices month over month change, actual versus survey, and it's the highest surprise in 22 years. Where import prices have gone up month over month in a pretty drastic way. So that's kind of interesting. I wasn't really thinking about that. Here's one that says, fun fact about gold. The shortest 8-year cycle rally on record was 34 months. We're in a new 8-year cycle, and it's only month 4. Think about that. Embrace the pullbacks and know your levels for higher lows. So this is the gold 16-year cycle. Year 13, 18, it started over new 2, all the way down to 14, 12, 16, and then we've got 10 and 14. In all honesty, I don't really know what these numbers are that he put on there, but we can see the chart. This is the way that I view this is this here was a demographic that came into home buying years, and we had a demographic that was larger that basically squeezed the market on up with a lot more credit coming into the system. We had a pullback, and then credit coming into the system had a pullback. The demographic from 1980 all the way till about the year 2000, we saw a decline in the growth rate of people and a decline in just housing starts in general. Then we had a larger kind of boom from 2000 all the way to 2011. This here spanned the top or peak in 2007. Then they reflated it after, and that's also, I think, added to the money supply, which pushed gold higher. But we're going to see that same, I think, scenario, a very similar scenario where we move on up to some level in the later 2020s for gold and for commodities in general. This is useless. It says this useless pet rock is less than 3% away from record levels on the monthly chart. Gold is money. Everything else is credit. I like that quote, and we are hopefully going to go and make new highs for gold. So again, guys, I think gold's looking fantastic. I think commodities in general are looking really good. Again, it's not going to be straight up. We're going to get pullbacks. Things will move and go up and down all over the place. It's not going to be a straight moonshot. Never is, never was, never will be. There are times where it's going to be an easier ride, and there's times where things get a little bit tougher. And I know a lot of people think they can time every single little movement, the 4 or 5 months and time all this. I think that's going to be a little bit more difficult than what most people think. Are we going to pull back now? Are we going to rocket launch higher? I'm in the rocket launch higher camp. I don't see the delinquencies. I think the housing market, if rates come back down, will be a little bit stronger. That's why we cover the housing market. The housing market is actually the driver of all this. Everything else is a derivative of it. So when you look at an inverted yield curve is a derivative of the housing market strength. And what that does is when the housing market is strong, inflation comes into the system, and they'll hike the rates up in the bond market, and it'll invert the curve. The question is, how long does that curve stay inverted? And is inflation coming back down? Is it going to cause a large recession, which is generally driven by real estate and the collapse and deleveraging in the real estate market? I don't think we have that scenario. I think we're in the middle of a construction cycle. where we could still go higher, prices higher if rates come back down and the affordability comes back down. The only way the affordability gets to these levels that are, we'll call it astronomically high, is because there's a shortage in the market. You can't have it be the other way around. You can't have a massive weakness in housing. At least you can create a weakness at the end, but that weakness that is created is by overbuilding. It's an oversupply. Now, are we in an oversupply? Some people are going to show me graphs. They're going to show me data. We're not in oversupply. We're still short homes that we still have to build. And what they're going to do is they're going to look at short-term movements, and they're going to say, it goes up, I'm bullish. If it goes down, I'm bearish. If it goes up, I'm bullish. But that's not how you look at markets, guys. You have to look at the data behind the movement of price. Why are home builders all moving higher off of a large, gigantic breakout? Answer that. Why are smarter people positioning in these companies, creating these patterns where we're getting breakouts to the upside? Why? How is that possible? Is it because that we're in the middle of a construction cycle? Yes. Yes, that's what it is, in my opinion, at least. And we can see that by evidence in the charts of the home builders, because the home builders look very strong. We can also see that affordability is pretty bad, and that's what we went over today. And it could be kind of nasty for a period of time because the affordability is really bad. And when that interest rate comes back down, because inflation, remember, that's measured as a rate of inflation growth. It's any sort of percentage is a rate. And then when that base comes up, I think it will slow down. Yep. And rates will come back down to some level that is more sustainable and more affordable. And I think the housing market will come back. Now, that's my opinion. Obviously, people can argue that opinion, till they're blue in the face. I understand that I could be wrong in that. But from what I see and where we are in the real estate cycle, that's my opinion. If you guys need any help, again, with the commodity bull market that's coming, finding-value.com, the platinum membership, use the word discount in the coupon code, get yourself a discount. And it is active. I know it expired, but I reactivated that. Join our community. We have fun in these platinum question and answer sessions. I will give you my honest opinion. If I think something doesn't look that great, I will let you know if a chart pattern that you're looking at or a company doesn't look that great. Pretty honest, truthful, straightforward with it. I am a longer term investor where I invest for this entire bull market. I'm not trading in and out of these companies. I could provide, a service, so to speak, if you guys want to try trading some stuff and learning. That is something that I can do. And I can help you guys in these platinum question and answer sessions if you guys want to do trading. And I'm not a big trader. I'll just say that, but we can do it. I have done it before. I've been successful doing it. It does raise the stress level a little bit, but I do know how to do that. And I can tell you where the resistance levels are at and all that stuff. And again, guys, the value in all of this, the value is in learning a strategy, learning portfolio position sizing, learning how to replicate investments and do it over and over and over to make money from either investing or trading. That is where the value is. The value is being able to replicate a strategy successfully. You can line stuff up, you can make money, but if you are really motivated to learn, that is where the money is made. It's figuring out why things move, when things are cheap, where to take a high risk play at the lowest risk opportunity. So when things are down and people are not looking at it, you can take a high risk company that is a lot of upside potential and buy it at the lowest risk time. That's what I try to do. I like playing the volatile stuff. I know it's a little bit harder to hang on to, but if you're buying things at a low risk time, you get the nice chart pattern. It's cheap. Things have pulled back. Things are on support levels. That's the time to increase the risk, is when things are kind of turning around or really low. You dial that risk back as things go up. So you don't want to be going into high risk things and chasing into companies, that can get you hurt. And we talk a lot about that. I know a lot of people are starting to change their mindset after they come to these meetings week after week or month after month, and they say, okay, this is how this guy's approaching it. That's the value. The value is on the approach. How is he selecting these companies? Why is he selecting it? How is he choosing which sector to be looking at? How does he pare down the sectors? And I know a lot of people have an idea, but there's also more to it than what I share on just these videos. But that's all I've got for today. Give me a thumb up, subscribe to the channel. We'll catch you guys next time. This is Finding Value.